All right, we have one final step that we have left to complete when we have finished manufacturing our product, selling our product. Now we need to go back, and this usually happens once a year at the end of the period. A company will adjust their manufacturing overhead account to what it should be. So let's take a look at how this happens. So if you'll remember everything that we purchased, okay, so for example, let me back up a step here. Remember with our manufacturing overhead, if this were our T account for manufacturing overhead, okay, whenever we purchased or paid for manufacturing overhead, we debited the account. Okay, so this is what we actually paid for utilities, for insurance, for taxes, the depreciation. But as we used up this manufacturing overhead, it went somewhere. Remember, it went over to the work in process account. And the way it got to this work in process account was because we were using that predetermined allocation rate. Remember, we used a 40% rate here to get it over there. All right, so what we're concerned about at the end of the period is, if you'll notice, underallocated. What does it mean by underallocated overhead costs? This happens when the actual, okay, this is our actual amount, when what we actually spent is more than what we moved over, okay? And so if we still have actual manufacturing overhead dollars left here, then I did not put enough into work in process. I underallocated my overhead. Okay, the opposite is true. Okay, let's say if at the end of the period I have a credit balance left out here in my manufacturing overhead account, that means that I have moved too much overhead over into work in process. So I moved manufacturing overhead into work in process that I didn't have. Why would I do that? Because we were working off of estimates, okay? And so we need to understand what's underallocated and what's overallocated. So I know that's a crazy drawing, but I think it will help as we move through these illustrations. So in this particular situation, it tells you that we needed a credit of $15,400 to bring the manufacturing overhead account balance to zero. So if we go back to my bad artistic drawings here of manufacturing overhead, this is telling us that at the end of the period there was $15,400 worth of manufacturing overhead still sitting out here in my manufacturing overhead account. It can't be. It's not like raw materials. I don't have raw materials. I may have raw materials left over that I haven't used yet, but I shouldn't have manufacturing overhead left sitting in this account that I haven't used. So at the end of the period, at the end of the year, this account needs to have a zero balance. Well, based on what you've learned on debits and credits, how can I get this to a zero balance? I need to credit it. Well, this is what your journal entry has done. If I credit this account for $15,400, here we see the credit. I have to debit something. What is that going to be? In most cases, unless this amount is a very large or a very material amount, I'm going to debit cost of goods sold. Okay, hold on to these thoughts. We are going somewhere with it. Okay, so what happens in the situation, remember we used a predetermined overhead allocation rate. We were using estimates to figure out how much overhead needs to get allocated to work in process. Okay, so at the end of the period, if the actual amount that we spent on overhead is more than what we have actually spent, the illustration that we just looked at, should we back up? Okay, in this particular case, we are saying that we had $15,400 left in manufacturing overhead. That means that these are costs I incurred that I did not move into the cost of finished goods. And so what happens here is I have underallocated my cost. And if I haven't moved enough into finished goods, then I haven't moved enough into cost of goods sold either. And so even though we're using an estimate to come up with our estimated cost of our product, ultimately at the end of the year, we don't want to see sales less estimated cost of goods sold. We want the actual amount of cost. So when we adjust overhead at the end of the period, we are adjusting it to cost of goods sold, unless it's material, and then we have some other options that we will look at later. On the opposite side of that, okay, if our actual costs are less than what we actually allocated, all right, if we were to move back here, let's see if I can find an eraser. Okay, so let's say that at the end of the period, I had $15,400 credit balance in manufacturing overhead. That means I have moved out of manufacturing overhead into, and if we'll remember, where were we sending this? We were sending manufacturing overhead into work in process, and we were sending work in process into finished goods. Okay, and I have sent finished goods once they were sold into cost of goods sold. Okay, but think about it. When I'm talking about manufacturing overhead, what have I been moving over? An estimated amount every time. I have estimated how much overhead should go into work in process. That estimate has flowed through to finished goods, and it has also flowed through to cost of goods sold. And so in this case, I moved too much. Using my estimate, either my base was too low or my driver was too high. I've put too much overhead into work in process, and in order to correct it, I would have to debit manufacturing overhead and credit cost of goods sold. And when I credit cost of goods sold, what am I doing to it? Notice our little arrow here. I am decreasing it. Why am I decreasing it? Because I originally put too much manufacturing overhead out there. Okay, so we have to adjust our estimate down to actual at the end of the period. So in summary, we can look back through our journal entries to see I purchased raw materials. I moved those raw materials into work in process, the direct and the indirect. I took them out of the raw materials inventory with a credit, and I moved them into work in process. We did the same thing with wages. As our workers were working, instead of debiting expenses on our income statement, we debited work in process or overhead for that labor. Tracking cost per job. Remember, all of our manufacturing overhead, these were actuals, actual cost, actual depreciation, actual utilities, actual insurance. Okay, so we're debiting manufacturing overhead for the actual overhead that we incur. Then we allocated it. So you notice when we took it out of manufacturing overhead, it was a credit. And where did that credit go? It went into work in process. When the product is finished, it moved out of work in process and into finished goods. Notice everything before was a debit to work in process, but when it is finished, we take it out with a credit, and where does it go? It goes to finished goods. Then we sell the product. We have our journal entry for sales and accounts receivable. And now all of that merchandise that we put into finished goods inventory, if we have sold it, we are taking it out of finished goods inventory and putting it into cost of goods sold. And you can tell here, if we had $644,600 worth of finished goods inventory and we only moved $584,600 into cost of goods sold, I didn't sell all of it, just some of it. All right, and then finally we see our adjustment here for manufacturing overhead to get it to its zero balance. So in summary, we can see that in the T accounts as well. All right, and if we will back up here, you can see the $664,000 okay, that was moved into finished goods. Okay, well, let's take a look at that in our T accounts. That's exactly what came out of work in process into finished goods. Okay, if this is all we have, and I were to give you this illustration and say, what was the total cost of inventory that we sold this year? Well, we can go to cost of goods sold and see that we sold $584,600 worth of merchandise. That's what came out of finished goods inventory, right? Well, sort of. Remember our last step. Our final step was to adjust for $15,400 worth of manufacturing overhead. So our total cost of goods sold for the year is going to be $600,000. Even though all we moved into finished goods inventory was $584,600. This $584,600 was missing some manufacturing overhead. We underallocated overhead, and at the end of the period, we had to adjust for it, and that adjustment means I had to get that $15,400 worth of manufacturing overhead into my cost of goods sold account where it should be. So the product, the merchandise that I actually sold cost me $600,000 and not $584,600. So we can't account for the total cost of goods sold until we have accounted for manufacturing overhead. We can see these calculations. You've seen them in T accounts. You can see it in the cost of goods manufactured statement here, that we manufactured $644,600 worth of overhead. Of our product. What we don't see is the under or over allocated overhead, because that hasn't been accounted for yet. But it does get accounted for in our income statement once we do our adjustment, and so our total cost of goods sold is $600,000. Hence the fact that cost of goods sold may not always equal cost of goods manufactured. Okay, so we'll take a look at what happens. Everything we've looked at is for a manufacturing organization, but the same process happens for a service organization, other than they don't have inventory or manufacturing costs. Mainly what takes place there is direct labor. However, a service company still may have overhead that needs to be allocated, and we would use the same process to come up with an estimated overhead, an estimated driver, and an estimated allocation rate. And we would use that allocation rate to get overhead into the cost of our service. Okay, so this is the end of our job order costing chapter. You have some homework problems that you need to review after finishing the lecture and reading your chapters.